Jeff Bezos, Mark Zuckerberg, Peter Thiel, all examples of billionaire corporate insiders that were selling their stocks in March of 2024. Once again, corporate insiders have timed the market perfectly. They sold their shares right before the stock market dropped by around 6%, wiping out around $2 trillion of market cap in just a couple of weeks. This is a chart that we highlighted back in early 2024, and it showed the highest level of corporate insider selling over the last year. The chart we showed to our members right here, and it turns out they were right again. Anybody paying attention to them would have avoided this steep correction on the S&P 500. The question is whether they sold at the top of a small 6% correction or a large 25% bear market like in 2021, or like they were selling back in 1999 when we know that there was a historical amount of corporate insider selling before a 50% drop in the stock market. Now, first of all, this correction was predictable. The S&P 500 had gone 154 days without touching its 50-day moving average, which was an extremely long streak that has actually rarely historically happened. At the same time as this was happening, you had interest rates that were rising. The 2-year yield that you see on this chart went from around 4% in January of 2024 all the way to 4.7% by the end of March. So the lower interest rate environment that we saw between October of 2023 and January of 2024 that pushed the stock market higher for a huge rally completely reversed in the first quarter of 2024. So there was a divergence between what the stock market was pricing in and what interest rates were expecting. This was even reflected in something called the breadth of the market. In late 2023, 90% of stocks were trending above their 50-day moving average. And yet by March of 2024, that came down to around 75% of stocks. So although during that period of time, the stock market was rising, the number of stocks that were participating in this rally was going down. Now that just explains why we were looking for a correction in March of 2024. Corporate insiders don't really look at this kind of thing. There's a few reasons why insiders sell. They might think their company is too expensive, and so they don't think it's worth holding those shares. They might have access to data that's suggesting their company is going to see weaker numbers in the next few quarters, or they might think that the stock market is just temporarily too optimistic about the performance of their company. This is what we think was going on in March of 2024. The S&P 500 rallied by a staggering 30%. Most companies don't see a plus 30% change in their revenues. So corporate insiders were probably looking at their steady revenues, thinking that a 30-40% rally in their shares price was not justified and probably worth selling. Today, those very same stocks that were rallying in the first half of the year might be down 10-15%, with corporate insiders scooping back up those cheaper shares. For now, that's our base case and why we closed out our short trade on the S&P 500 last week. Because when we look at the job market, we see that initial jobless claims are still trending lower. And as long as initial claims stay at low levels, the stock market could have more fuel. We see back in 2008, the vicious bear market that led to the financial crisis really began when initial claims began to trend higher. In 2000, the top of the market that led to a 50% decline started when initial claims began to rise. That was also the case in 1990. The bear market only began when initial claims started to rise. When we rewind all the way to the 1970s bear markets, like in 1970, 1973, and in 1982, all of these bear markets were accompanied by rising initial jobless claims. And the only bear market that did not occur with rising jobless claims was in 2022 when initial jobless claims were still at very low levels. So the fact that initial jobless claims are staying low today is telling us that this correction on the S&P 500 is probably not going to lead to a massive bear market and could end up being quite shallow and lead to higher highs until we finally do start to see initial claims move higher, and that lead to a more significant correction on the S&P 500. When this happens, we would expect the stock market to decline by well over 30%. But today, the S&P 500 is in a solid technical structure. It broke out of a key price channel in early 2024, and the S&P 500 is now just retesting this key level of support without any solid signs of a recession materializing. So our base case today is that insiders sold here in March of 2024 because the market was too overextended, not because they were sniffing a big crash that was coming like in late 2021 before this 25% drop in the market. That's why we've slowly been adding equity exposure to our list of trades at Game of Trades, because we think there's a good chance that the market holds this key level of support. If it doesn't hold, however, and the market breaks down, the technical structure of the market takes a big hit and opens the door for much more downside in the coming months. We're watching these technicals very closely at Game of Trades. Don't forget, you can join our service completely for free for 7 days.